Okay, good morning, guys. Let's have a look here and see what's happening. A little review of yesterday and then a look ahead. Another interesting day in front of us. So, yeah, pretty interesting day yesterday, I would suggest, to say the least, really. I mean, plenty of movement across asset classes. Plenty of data, conflicting data, particularly from the US. But before we kind of get into the US, let's perhaps talk about Europe. And if we look at the DAX chart on the top right here, we just before I got on the mic, up testing yesterday's high. And we've got a similar scenario on Eurostoxx. Eurostoxx not quite up to yesterday's high yet. And in fact, let me just bring in my Eurostoxx chart, because we've been looking at a sort of rough upward trend channel, and yesterday's top, having broken up above the 23rd of July high, we pretty much hit the top of the channel, and then we've pulled back. If I zoom out a little bit, you've still got some movement to go yet until we get up to the highs we had on the 20th of July. But generally, pretty positive day for European equities yesterday. More solid data. This time, services PMI coming in, pretty much mostly better than expected. There are a few exceptions here or there. The Italian figure, for example, got revised lower, but generally it's been a good week for data from Europe, with the manufacturing and services PMIs both suggesting that we've got a pickup in economic activity, both suggesting that that deflation trap that was the risk earlier in the year is continuing to drift away. And so European stocks particularly benefiting, and we had a pretty good inverse correlation with bonds yesterday. And if I just enlarge the Bund chart slightly, big steep move to the downside on the Bund yesterday afternoon, helped along by, in the end, well, actually, no, I was going to say helped along by strong US data, but actually a lot of the move happened on the Bund before the strong US data that got delivered at 3 o'clock. We had more downside at 3 off that data, but actually a large part of the move came before then. And this may be, maybe a bit of a rotation out of some of these sort of European long duration bonds, or mid to long duration bonds. With, generally speaking, yields driving quite a bit higher yesterday across the geographical space of the Eurozone. And so a pretty straightforward day, perhaps you might say, with regards to European equities marching higher, European bonds selling off. So that was one thing. But then when you're looking at US markets, it was a lot more radical, the movement in terms of price action in both directions. And maybe the Eurodollar is the best market to look at here. You can't quite really see it on this time frame, but I'm just going to zoom in a bit on yesterday's action. Let's maybe go just to a 10-minute chart and just have a quick look back at the afternoon. Sorry, let me just load this up. Let me just zoom back here, because it was a pretty remarkable afternoon. So the two key bits of data yesterday, both very conflicting, with first of all the ADP employment report leading to this move to the upside. Fewer jobs created in July than expected, according to the ADP. 187,000 jobs. We were expecting 215,000, and with the Fed meeting just 5 weeks away, as I've been saying, any labour market related data is getting very close attention, and this was bad news, and so the dollar weakened quite sharply. But it was a move that happened very, very quickly, and then things calmed down very, very quickly. Just given the fact that the ADP report isn't necessarily a labour market report that normally gets too much attention, given that we have payrolls just 2 days later. So things settled down, and it was perhaps the ISM non-manufacturing data which ultimately led to the complete reversal back to the low. So this came at 3 o'clock, and these were huge numbers, very, very bullish numbers. The ISM non-manufacturing data hitting a 9-year high, or even a 10-year high, and most of the subcomponents also hitting sort of decade-long highs. The new orders component at a 10-year high. We had the employment component rising, the biggest rise in the employment component in history. Just bear in mind that means just over the last 30 years. That's when they've been measuring this. So for the last 30 years, since this data has existed, the employment component hasn't ever jumped so much in 1 month. And so this kind of completely contradicts that ADP number that we got just a couple of hours before. So pretty interesting session, big move higher off the ADP, dollar weakness, bad labour market news, then big move lower at 3 o'clock with the exact opposite. And then in the end, we did indeed find support back at the morning's low and drifted back higher, and indeed drifted back higher as we went into the close. And if you look at the daily chart for the euro dollar, sorry, here we go. Look at the daily chart, you've got almost a perfect doji here for yesterday's price action, which I guess in hindsight sums it up perfectly. One piece of bad news and one piece of very good news nets off, and the dollar doesn't move. So pretty interesting session. And of course, I guess that data yesterday, now we put it behind us pretty quickly, because ultimately everyone's waiting for Friday's payrolls number and the average hourly earnings data, and then we'll go from there. So interesting day for the dollar, very volatile. Crude oil then, let's have a quick look here, because again, really interesting event on the crude inventories data announced at 3:30 yesterday afternoon. Pretty tricky one to navigate through, because again, it was mixed data. So the inventory drawdown last week was higher than expected. It's the second week in a row that we've seen crude oil inventories drop by more than 4 million barrels. So that's bullish, and initially the price spiked higher and we hit 46.68, and this was a key level from back end of July. In fact, it was the July low, 28th of July, 46.68. That's where the spike ran out of steam, and then we got the news that actually production levels in the US had risen. And so more evidence of the resilience so far by the shale industry in terms of, despite the price of crude being so depressed, you're actually still seeing the shale industry at least maintain output, if not marginally increase it. So, quite phenomenal. And that news kind of saw the reversal, and we in the end got down and made new lows for the session, and we broke below Monday's lows, where we made new lows for the month. This has been a key price point this morning, 44.83. Today's low, that was yesterday's low. So, and when we look at the daily chart, you know the story here. I mean, the steepness, if that's a word, the steepness of this decline has been quite exceptional. I keep having to redraw this percentage change line. Let me do it again now, just to kind of keep tabs on, what's the percentage move overall from that high point of the year back at the 6th of May, and we're now at 28.36%, with most of this coming in the last 6 weeks. So we're still, and that test of July's low, very important technically. This thing stays very negative still. And when you're moving into the end of the week and thinking about the dollar's value, if, and it is an if, we get strong labour market data on Friday and the dollar strengthens, well then, you're going to see commodity markets remain under pressure. So definitely one to keep your eye on this. I've got a few charts and graphics to show you on this stuff in a minute, but let me just kind of complete the rounds here by looking at the S&P, which, again, a lot of these markets went through some pretty remarkable moves in both directions, and the S&P's no exception, driving strongly higher in the morning, helped along by a bullish Europe. And we went up and up and up, and in the end, even after the ADP report, it was a bit of a delayed reaction. I say delayed, it took about 5 minutes. Then the S&P really broke higher. So this is bad news about job creation, but of course good news in terms of the Fed holding off and waiting, delaying their rate hike. So the S&P climbed. Then we got the ISM number, and at the time it was so strong. I was perhaps expecting the S&P to sell off. It actually didn't, and it drifted higher, which was very surprising at the time. But of course what happened in the latter part of the session was then perhaps what I was expecting to happen straight away after that data. It was so strong that surely the rate hike fear element comes in and dominates. And in the end, that happened, but it was difficult because first the market did drift and march higher, but then we got a pretty radical sell-off into the close. And ultimately, again, looking at the daily chart, we in the end, we had an update of 0.5%, but it still puts us firmly in the kind of middle. We're still in the middle of this very wide range that we've had for the year. So still all to play for, and really just waiting for Friday. We do have US data today, but it's not anywhere near as important as Friday's numbers, tomorrow's numbers, of course. Really interesting session yesterday across markets. A couple of graphics. Just on crude oil, Bill's been sharing a chart this morning, just looking at the production change over the last 7 months. And this is the period, of course, where the price of crude oil has radically declined. And who's responsible? And actually, over the last 7 months, we've actually seen OPEC increase output, with Saudi Arabia and Iraq being at the top of that list. You can see here, like the last few months, we've seen Saudi and Iraq substantially increasing output, which actually puts OPEC's output of 1.5 million barrels a day more than it was in November. So their messages were not cutting production, but their message was were hiking and increasing production, and yet that's exactly what they've done. They've been trying to tell us, we're going to maintain production, but they haven't. They've increased it. And so this is definitely a part of the story that's leading to this move to the downside we've seen over the last 6 weeks, coupled with the fact that as it stands, the shale industry in the US has remained resilient, and output has not fallen in the US yet. And it's hard to know. I mean, how low does price have to go for US output to actually begin to decline? But so far, the Saudi Arabians, along with Iraq, have managed to keep output on the up, pushing prices down. Another interesting story about this was the fact that Saudi Arabia announced a big bond issuance overnight. So the Saudis are going to be issuing a 27 billion bond issuance, and this is further sign that the length of time that price has been low now compared to last year, we're looking at sort of 7-8 months now of price incredibly depressed from the year before. And so this bond issuance from Saudi is perhaps a sign that these guys are beginning to feel the heat. I mean, Saudi Arabia have got so much reserves, but they are spending it. In order to maintain government spending, they've had to dip into reserves, because obviously the revenue generated from oil exportation has dropped quite sharply as a result of the price drop. So they have been eating into it, but they've still got plenty left. I mean, before the drop in oil price, the Saudi Arabia sort of fiscal reserves sat at about $737 billion. That was summer of last year, $737 billion. They've spent about $65 billion of that to maintain government spending, so their foreign reserves are down to $672 billion. So, i.e., pretty sizable. They've only spent less than 10% of their foreign reserves in order to maintain government spending in the face of sharp decline in the price of oil. But they're going ahead with a bond issuance, which perhaps suggests that, well, I guess you could look at it two ways. Maybe you could say they're beginning to feel the heat, but you could actually say, well, this is them funding themselves for and digging in and making sure the price of oil stays low for longer. And so they're just raising funds here to help them through that. So this maybe is a signal that they're more than happy to keep price down and maybe even drive it lower. I mean, surely that's what's happening. If they've been increasing output over the last few months, well then that's a clear signal of what their intentions are, and that is to try and drive price down. So, pretty interesting. And just talking about the Fed, which we've been talking about a lot recently, of course, a couple of interesting graphics in the FT this morning. Just looking at the long-term interest rate changes. This is a chart looking at the Fed funds target rate, so that's the Federal Reserve's interest rate, that's the yellow line, and then the blue line is the US Barclays aggregate bond yields. So this is looking back over the last 40 years. Obviously, the correlation's very strong. But just to say that, we're at zero interest rates. Interest rates can't and won't go lower. They will only go one way from here. And so maybe talking a bit more broadly about this 30-year bond rally, we've had a 30-year bull market for bonds. See the blue line? This is yields dropping, so that's price moving higher, and generally we've had a 30-year move to the upside, with a few interruptions obviously along the way, but the trend is very pronounced. The only problem is, of course, yields are at zero. So you're not going to have yields going lower, so therefore you shouldn't either see bond yields move lower. So, we should be at the bottom here. This 30-year bull market, literally mathematically has to be over. It's quite remarkable the kind of returns you could generate through this period. You're looking at, if you'd have bought the US Barclays aggregate bond yield fund back in 1980, you'd have seen a capital return of 8.8% a year, which is pretty phenomenal. Equities have actually marginally outperformed that. Equities over the same period, you'd have seen a return of, around about 9.5%. So it's very close, but of course being invested in equities, sure, your return would be higher, but it comes with radically more volatility. But the days of bond returns being phenomenally high are gone. You can't, it's literally impossible mathematically to get a continuation of this bond market rally. Rates are at zero, and they're going to go one way from here, and that's up. So maybe this 30-year bond market rally is finished, but the better question, I don't think there's too much debate about that. The interesting debate is what happens now. Do we now begin the bond market bubble burst? Do we see bond yields rise very sharply? There's a lot of liquidity problems in this market, so there is a fear that if we do get some kind of shock, then if investors start trying to pile out of these bond markets quickly, well, there's not enough liquidity to deal with that, and it will potentially lead to very radical spikes in yield and radical drops in price. But the chances are that's probably not going to happen, or at least you might get flurries of it, these kind of flash moves, but because of liquidity problems. But unless we get a shock, and that shock would have to be something like, inflation jumping higher and the Fed having to raise rates much faster than they are currently communicating. So it may well be the end of the bull market, but it doesn't mean necessarily it's going to be the start of the bear market. So quite an interesting debate. So we'll send this FT article through so you can have a read. Okay, let's look at the session ahead, and let me just bring up my economic calendar. So we've got an interesting day. In fact, we've got a unique day. Big changes with how the Bank of England communicate with us. So let me talk about that in a minute, but we'll just talk about the data first. So here's a look at the list. As you can see, we've already had things like German factory orders. These came in at 7 o'clock, much better than expected. That's helped with the DAX on the upside this morning. 2% for June. Factory orders up 2%. We were expecting an increase, but only of 0.3%. So that's the German factory orders done. Good news. Not much else of much significance. We got new car registrations from the UK at 9. We've got retail PMIs from Europe at 10 past 9. This stuff isn't important. We had the retail sales figures already yesterday that disappointed. Then we start getting into the meat of the action. So industrial production from the UK at 9:30, also manufacturing production. Then it's the big event of the day. I'll talk about this in a minute. So it's the Bank of England event, Super Thursday. Out of the US this afternoon, just initial jobless claims to look out for. So definitely the big event will be the Bank of England. So let me just show you a bit of a graphic here, because they're massively changing things up. So this is being called Super Thursday. They're changing the way they operate in terms of how they communicate with us. Up until this point, the system has been that we've had a policy meeting once a month with the first Thursday of the month. So this is, normally it would start on the Friday before, you'd get the MPC meeting with staff presentations to the MPC, the Monetary Policy Committee. Then on the first Wednesday of the month, the MPC deliberation meeting. This is where just the policy committee themselves, as 9 people, meet and discuss. With then the day after, so stage 2, they would finish their meeting and then they would announce any monetary policy decisions. Okay? That was it. They would just say, are we changing rates or not? Then we have to wait a whole week, and if they deliver an inflation report, but this is only once a quarter. So only once a quarter would you get an inflation report 1 week after the Bank of England rate decision. So normally, actually, all you'd get is the Bank of England rate decision, then nothing for 2 weeks when they would report the minutes from that meeting. In the minutes, you would get much more detail about what happened, what was the voting. There's 9 people on the committee. Did everyone vote for no rate hike, or were there some parts of the committee that voted for a hike? So this is a pretty archaic way of communicating, and so they're revamping. And so if you look on the right hand side, this is the new setup. So they start earlier. The process starts the Wednesday, so I guess the last Wednesday of the month. You're going to get that pre-MPC meeting where you get staff presentations. Then the last Thursday of the month, you get the stage 1 deliberation meeting. Then you move into the first week of the month, and here they discuss their policy on the Monday. Then it's on the Wednesday they have their decision meeting. Then it's on the Thursday, that's today, this is Super Thursday, where they deliver a massive amount of information. So firstly, as normal, are they changing interest rates? Secondly, you're going to get an inflation report and a press conference. That's only 4 times a year though. Only once a quarter will we get the inflation report and the press conference. This is happening today, okay? Also, we're going to get the minutes from the meeting released immediately. So we don't have to wait 2 weeks anymore. We're going to get it straight away. So today we will get the interest rate decision, which will absolutely be unchanged. We will then get the minutes, which will show us the voting. So of the 9 members, how many voted for unchanged? Of course, it would have to be a majority, so at least 5. But the interesting thing today is it's most likely, for the first time this year, we're going to get some members of the committee voting for a rate hike. So actually what we're maybe expecting today is for McCafferty and Wheel, the 2 hawks on the committee, both to have voted for a hike. So we're expecting maybe a 7-2. 7 members saying no hike, 2 members saying hike. So this just reshapes our forward expectations. If you're starting to get some members of the committee voting for a hike, well, maybe this suggests that first interest rate hike is going to be sooner. But I would caution, McCafferty and Wheel were voting for rate hikes throughout the second half of last year. So it won't be a major dramatic event if again they start voting for hikes. What will be really interesting, the day that 3 members vote for a rate hike, we need somebody else other than McCafferty and Wheel to vote for a hike. Then that's very significant. This will be that kind of mid part of the committee, the neutrals beginning to be swayed by the hawks. Then we know that the rate hike's soon. So much information here today. 12 o'clock, are they changing rates? That will be a no. And we get the minutes reported. Then we get the inflation report and Mark Carney's press conference at 12:45. This is definitely going to be interesting. It's unique. This has never happened before. So we'll see what happens. So, things like cable, or sterling, I should say, against any currency is going to be particularly volatile as we go through this new way of talking. At the moment, cable's been very stable over the last few sessions. Really, over the last couple of weeks, been very flat, really chopping around the 156 handle. If you look at this on a daily chart, actually, we zoom in a bit. Look at this pennant we've got happening here. After some substantial movement in June to the upside, and then in July to the downside, we've now stabilised, and we're right into the angle of this pennant. Something's got to give here, and it will most certainly, I would imagine it will be today's Bank of England meeting that will get this currency pair outside of this pennant. Which way it goes, of course, we'll have to wait and see. If it's somehow, I can't see how it's possible, but let's say somehow the market stays within this pennant today. I cannot see that happening. But let's say it did, well then we got Friday payrolls. So, I mean, that's certainly going to take, this pennant will break in the next 30 hours. I guarantee it. The only problem is we don't know which way. So we'll have to see what the information is. Will we get a hawkish Carney? Or will we get a dovish one? I mean, listening to him recently, he's been very hawkish. So you would anticipate maybe we're going to get Wheel and McCafferty voting for a hike, and that we're going to get Carney being on the hawkish side, which perhaps should lead to sterling appreciating in value, and we maybe drive up and test these key tops throughout the month of July. Of course, he could surprise us, and it would be a surprise if he's dovish. So you're going to get a bigger move lower off a dovish Carney than you would get a move higher off a hawkish Carney. But then ultimately we've got payrolls tomorrow, which is hugely important for the dollar. I mean, massive. This is the biggest payrolls number, well, I don't know, for years. And so you're going to get radical movement because we're going to look at the payrolls number tomorrow and ultimately make up our minds. Are they going to hike in September or not? So expect some big movement on cable over the next 30 hours. Okay, so that's it for now, guys. We've got data coming out of the UK in 25 minutes in the form of industrial production and manufacturing production. And we go from there. Thanks a lot.